Happy Monday, everybody. Today is March 30th, 2026, and this is your Monday market update. Now, just one quick note before we begin. This is our final Monday market update of the first quarter. It's always good to take a moment to pause, take a step back, and reflect, not just on what markets did week to week, but how quickly narratives can shift over just a few short months. Now let's get back to the market. Let's recap last week and let's preview what's in the week ahead. The week began last week with a sharp rally to start trading as markets responded to a sudden shift in tone out of Washington. President Trump announced a pause on planned strikes against Iranian energy infrastructure following what he had described as productive conversations, and that triggered a broad relief rally. Stocks reversed early losses and moved higher, while oil dipped higher sharply, helping ease immediate inflation concerns. But underneath that move, there was already some skepticism. This was more of a headline-driven reversal than a structural shift, and while it justified some buying, it didn't yet change the bigger picture. The Dow was up about 1.25%, S&P up just over 1%, the Nasdaq was up roughly 1.25%. By Tuesday, that skepticism started to show up in price action. Markets moved lower as oil rebounded, yields pushed higher, and investors began to question whether any real progress had actually been made. At the same time, weaker global data and early signs of stress in private credit markets added another layer of pressure. The Dow was down about 0.25%, S&P down roughly 0.5%, and the Nasdaq was down about 0.75%. Midweek, markets found their footing again. Reports that the U.S. had sent Iran a 15-point proposal to help push oil prices lower and equities higher. That's what it did, with technology stocks leading the market, but the rally lacked conviction. As Iran rejected the proposal and negotiations appeared uncertain, volatility picked it back up again, reinforcing that this market is still being driven by headlines, not resolution. The Dow was up about 0.75%, S&P up just over 0.5%, the Nasdaq was up roughly 0.75%. By Thursday, the tone shifted more decisively. Oil surged, yields moved higher, and equities sold off sharply as investors began to reprice the likelihood of a prolonged conflict. The Nasdaq officially entered correction territory, and importantly, this wasn't just about geopolitics anymore. Rising oil was feeding directly into inflation expectations and tightening financial conditions, creating a more complicated backdrop for both the Fed and equity markets. The Dow was down about 1%, S&P down roughly 1.75%, the Nasdaq was down about 2.5%. Friday really defined the week. Markets opened lower and never recovered, with a steady, methodical sell-off driven by worsening geopolitical headlines and fading confidence in any near-term resolution. The Dow dropped nearly 800 points and entered correction territory, while oil continued to climb, solidifying its role as a primary macro driver across markets right now. The Dow was down roughly 1.75%, S&P down about 1.75%, and the Nasdaq was down just over 2%. Let's do a short wrap-up of the week. When you step back, this was a week defined by one key dynamic. Markets started the week pricing in de-escalation and ended the week pricing in duration and uncertainty. And oil sat right in the middle of that shift. For the week, the Dow was down just under 1%, S&P down about 2%, and the Nasdaq was down roughly 3%. Under the surface, energy outperformed while technology lagged, highlighting how rising oil and higher yields are starting to pressure growth assets. Quick note on corrections: defined as declines of 10% from recent highs. They are actually quite common. On average, the market experiences a correction about every 12 to 18 months. Some years you may not get one at all, and other periods you might see more than one in a relatively short window. It's not a perfectly timed cycle, but over long stretches they do show up regularly. What's important to understand is this: most corrections are short-lived, often resolving within a few weeks to a few months. They do not typically lead to bear markets, which are 20% declines, and they frequently occur within ongoing bull markets, not just during downturns. So while the term correction can sound alarming, especially when it's repeated in headlines, it's actually a very normal part of how markets function. Current drawdowns from recent highs, late March of this year, the Nasdaq Composite was down about 10 or 11% from its high. Dow Jones Industrial Average is down about 10% from its recent high, and the S&P 500 is only down about 6 to 8% from its high. Now, what's notable here is not just the level, but the sequence. The Nasdaq led lower and confirmed the correction first, driven by pressure in tech and AI names. The Dow followed, reflecting broader market weakness tied to energy and inflation concerns, and the S&P is sitting just below that 10% threshold, close enough that headlines are starting to shift. For the year, the S&P 500 down 3.7% year to date. Dow Jones down about 3.5%, and the Nasdaq down about 5.5%. If I gave those numbers to you first, the rest you may not even notice. That's the point. Stay focused on the signal, not the noise. One last macro note: there were also some secondary headwinds building, private credit stress, AI momentum slowing, and signs of more stagflationary backdrop. Looking ahead, this is a holiday shortened week, again, with markets closed on Friday in observance of Good Friday. The three key themes remain in focus. First, geopolitics. Markets are no longer reacting to headlines alone, they're reacting to credibility. Until there is a clear and verifiable path towards resolution, volatility is likely to remain elevated. Second, oil and inflation. Oil has now become the central macro variable. When energy prices move this quickly, it impacts inflation expectations, bond yields, and equity valuations almost simultaneously. Third, the Fed. This is where things get more nuanced. Rising oil prices and sticky inflation data create a more complicated path for policy, limiting flexibility at a time when growth signals are already softening. Now, from a data standpoint, the focus is going to be on labor and consumer strength. We're going to get consumer confidence and job openings on Tuesday, that's tomorrow, retail sales and ADP employment on Wednesday, and then March jobs reports on Friday, even with equity markets closed. On the Fed front, we'll hear from several key policymakers throughout the week, including Fed Chair Powell and New York Fed President Williams today, followed by Goolsbee, Barr, Bowman, and others throughout the week. The message from the Fed is becoming more balanced. They're acknowledging both sides of the equation, growth risk on one hand and inflation risk, particularly from rising oil, on the other. In other words, policy remains in a holding pattern, but with less flexibility if inflation pressures continue to build. One more forward-looking note. We are now about 2 weeks away from the start of earnings season, which will begin to shift focus back towards fundamentals, margins, and forward guidance. Now, as we wrap up not just the week, but the quarter, it's worth remembering how quickly the narrative evolved. From early year optimism to inflation concerns to geopolitical risk now taking center stage. That's the nature of markets. They don't move in straight lines, and they rarely follow a single story for too long. This is one of those periods where the day-to-day moves can feel chaotic, but when you step back, the structure is clear. Markets are adjusting to uncertainty. They're repricing risk in real time, and they're doing it across multiple fronts. That's not a signal to react. It's a reminder to stay disciplined, stay focused on your plan, not the noise. Keep planning, and have a great week.